if you want to.
Did you start?
Yeah.
You hit record.
Recorded, but we can trim it, I think.
This might be fun to have in there. What do you think? Yeah. Your left shoulder isn't in the ear in there.
Okay.
Close enough.
Let's get closer.
Yeah.
We don't want to be too close.
Right? No. Elbow ring. 6 feet apart. Still a thing?
Yeah.
Yeah. Okay, good.
All right. Hi, everyone. This is Alec and Elizabeth, and we are here to do a couple of different things. One, we wanted to do a fun podcast to help other real estate agents maybe understand the parts of real estate that have remained a little bit of a mystery to them, and then also help consumers maybe understand the process and that our jobs are not all easy and glamorous as opening doors and staging homes. There's more to it. So it should serve two purposes. Alec has knowledge in title.
Yes, and escrow. Yep.
And I have some knowledge of real estate practices. So some. Yeah. I get humbled every day in real estate because there's always somebody.
There's always something to learn, right?
Yeah.
With somebody that's done it better.
Yeah.
Longer. There's also people that may not have the knowledge or education to catch up with you. So
right.
We're in the middle.
We're in the middle.
Yeah, we'll learn from people and teach people at the same time.
So this is our first one, and it will be awkward and uncomfortable, and we'll probably fidget too much. For probably us. I think it's more for us that it's awkward.
I'm good. I'm authentically awkward anyway. So
I just watched Simon Sinek's podcast on awkward is awesome.
Okay. Well, good.
So I was very relieved.
Mom, I am awesome.
I was relieved to find out that awkward was awesome.
Well, how many people are more awkward than people that aren't awkward?
We're all awkward.
Mm-hmm.
Yeah.
Agreed. Okay, back on track.
Back on track. Today we thought we would talk a little bit about the pros and cons of owner financing. So with interest rates being so high, we've had people inquire what owner financing looks like and if it's a better deal than doing the traditional bank financing and who might benefit from owner financing.
I wonder if it's easier to find a buyer that would want to do seller financing or seller that wants to find a buyer that wants to finance it that way. Is there a difference, you think, or does it just have to be this circumstance that just works out for both parties at the same time?
I think it has to be a little bit of a circumstance that works out. You have to both be open to it. The seller has to not need the money right away, right? A lot of sellers have to sell their home and they need all the money so they can get into their next adventure.
Yeah. I'm not a CPA, but I have done closings where the seller did not want that lump sum for tax purposes. Now, of course, I'm not going to answer the why I didn't research it because I'm not educated enough on that part of it.
Right.
But he didn't need the lump sum at the sale. He also didn't want the lump sum at the sale. He wanted those payments to come through as a monthly payment rather than just all of this money.
So similar to a rental, maybe.
I think so.
Like having some steady income that would come in at a certain interest rate.
Yeah, correct.
And eventually you would get a lump sum because that's how owner financing works.
So that can be a pro for the seller. It can also be a con for the seller, like you mentioned, if they needed to get all of that money now at the time that they sold the house.
Yeah, one of the things you have to worry about with owner financing for the seller is do they own it outright? And that's the best scenario is if they own nobody on the house because there's nobody regulating if they can sell it or not. So if the owner has a note on it from a bank or a lending institution, they have a due on sale clause. And sometimes when the bank finds out that they've sold it to someone else, they're like, we would like that money back now. So,
well, even if they had a loan to pay off and they found a buyer that could come in with the cash flow to be able to cover that, and then still the remainder of the proceeds that were left over would either be divvied out at that point or used as the financing piece of it. It just depends on the buyer as well. But if the buyer's not able to come in with anything down, you're correct. You essentially cannot pay off that loan through the closing.
Or if they owe more, then they can sell it. Or if they owe more, then so.
Part is when you record that deed, then the taxes are going to show a different owner. And if that lender, if they have an escrow account, is typically where you see that come into play is they'll notice that the tax statements are being sent to somebody else.
So they may not notice it right away. They notice it in a year or...
Well, like in where taxes come out every 6 months, right? So they could see it at that point. It just depends. And maybe you have a lender that doesn't care, doesn't notice. But you're correct. If they find out that somebody else has taken over essentially the ownership of that property, they could call that loan due at that point.
And I've seen, because as a real estate agent, I always love working with lenders that I know that are part of the community. But the downside is that in this scenario, if I see them at the grocery store, like, oh, how's your house? Oh, I moved into another one and I sold it. Because you do see people around town and they do find things out. It's not like a big mystery.
Right. Yep.
The benefits of living in a small
in a
community.
smaller town. It is still small here, by the way, even though it's growing.
Yeah, Boise and Idaho have 1 degree of separation, I've decided.
I think so.
Maybe 2.
I know a lot of people. I probably knew you.
Or you know me and I know him. So
Yeah,
then there's the 1 degree.
Kevin Bacon's got nothing on us.
Yeah. So, all right, a buyer who might want to do owner financing might be a buyer who is hoping to find a better deal with lower interest rates, although a seller may not cooperate that way. The buyer might have a lot of down money to spend, but doesn't have credit, needs to build credit. They might have bad credit. They've had a run of bad luck. I've had clients that got in a car accident, had big medical bills, and then maybe they got a divorce. And then it just was one financial disaster after another. And so they suddenly were in a position where getting good credit or having good credit was no real responsibility on their part, just to run up bad luck.
So conventional lending wouldn't work. Certain sense, but they have the down payment to be able to come in and maybe cover what the seller still owes on another loan.
Yeah.
And then use the seller's funds as essentially a lender to help purchase the house.
Yeah, and they might be, sometimes I can take the buyer to a lender and have the buyer give me a what if scenario. So if this buyer were to pay off these debts and get these things situated and maybe get a raise in their job, whatever the scenario is, they can give a assurance to the seller that in 2 years or 3 years they would be capable of refinancing it and getting the seller the bulk of the money.
Well, and a lot of times it's hard to educate maybe a seller that wants to be the lender on the purchaser and the buyer. They may not have the knowledge of that, but a lot of the transactions we've seen that our seller carry are only for about a 5 or a 10-year balloon payment. So you're paying over the course of a 30-year amortized loan with the interest you pay monthly. But once that 5 years, 10 years, whatever comes up, they're expected to then pay off that loan. And usually it's done through conventional financing with, your typical loans that you have out there through a refinance.
Or they know they're getting an inheritance. They can pay it off at that point.
And a lot of sellers will just take interest-only payments too. So they're collecting money monthly, but and then they're collecting the principal balance at the end as well.
At the end.
So there can be a benefit to a seller to do that as well if they know that maybe in 3, 5, 10 years they could use that lump sum of money
for something else.
They're just getting interest-only payments, essentially like rent, and then they have to pay off the loan that they gave them to purchase that house.
Okay, and they have to have a little bit of trust that the seller's going to take care of that, or the buyer's going to take care of the house. So there's got to be.
There's a little bit of that. I mean, they're not really a tenant at that point because they are owning the property. Typically, the title will transfer over. But at the same time, when you're signing conventional paperwork through a lender, you're acknowledging that you're going to keep that property in good condition because of the value that they're putting on with the loan that they're providing. And it's just part of that. A lot of times that deed of trust verbiage in there is keep the property in good condition.
And I'm glad you said deed of trust, because a lot of times people think that when you're owner financing, that if I stop paying my bills, paying rent or mortgage or whatever you're calling it, that you can just come and kick me out with the sheriff. And that's not how it works.
No, so the deed of trust uses the third-party trustee rather than what you may see through a mortgage, where it is kind of like a sheriff's sale. But the deed of trust would actually take you through the foreclosure process of a typical loan.
Like we saw in 2008 with the short sales.
Right.
A lot of that same process where the bank takes the house back, and in this case it would be would the title company be the one?
There's a trustee that's named in there, yeah. Okay. So that trustee's department would be able to kind of assist with getting that taken care of with the lender, which is in this case the former owner of the property.
So it has to go. And when I've done them in the past, I've always done it with the title company. So the buyer makes the payment to the title company's trust account. Is that right?
We'll have to do a little research.
We'll do research. Okay, that will we'll figure out
as I can get.
But I know it runs differently. It doesn't just get mailed right to the owner. But I also know that it doesn't necessarily get reported to your credit. So that might be something to add into the contract, that the seller will do the credit reporting and report that they're getting payments on a regular basis.
That's a good point. Finding how to make sure that that takes place.
Yeah.
Usually best in the contractual part of it, and then maybe even adding it into the note, just as the promise portion of that.
That's a good idea.
Loan as well. And the deed-Trust, those can be drafted in any way that the parties see fit.
Because it doesn't guarantee that they get credit built unless you ask for them to report.
Probably not. Right.
Yeah. Okay. Other questions?
Benefits for the buyer. I mean, we kind of talked about that a little bit. Depending on what the interest rate is, sometimes these sellers are carrying notes at a higher interest rate than what you would see on the market value for a conventional institutional lender.
Right.
But a lot of times, in order to make it more attractive for the seller, maybe they'll provide a lower interest rate for that as well. So it just depends on the circumstance of the current owner and what they'd be looking for. But I have seen it where it is lower interest rate, and I've seen it where it is higher. So it just depends on the circumstance.
And as a buyer, you want to be careful that you are getting the deed of trust. There is a contract for deed, which is a different type of product, and that is more of the, like when I buy a car from someone and I don't pay my bills and they put it on a tow truck and take it away. That contract for deed works very similarly. Idaho frowns on that. They don't love those types of. It's much better to do the deed of trust.
Yeah, it's hard to pick up that house and move it. But,
yeah.
Oh, that's not.
Well, they could kick it. Yeah, they can kick it. Yeah.
kick
Well,
it.
some houses do get moved.
They do.
Yeah.
But that's
But it's a big
historical district discussion for another time.
or the one at the VIN number.
Right.
They can be
Those do get
moved.
moved.
Yeah.
We do.
My camper gets moved a lot.
Okay. That's good.
I had to live
By yourself.
Yeah, by myself.
Good.
During COVID, I got put in that trailer in the driveway.
Yeah. Another benefit of the seller financing piece of it is it may just not take as long to close.
Oh,
Because
quickly.
with your circumstance, with your situation you were describing earlier with the credit, it may take a long time to build that credit back up. So they may not be in a position to buy for a while, or 30 or 45-day close with an institutional lender.
Right.
Maybe they're ready to move in now. Maybe the seller's ready to move on from that, but they couldn't find any other buyers, so they sweetened the deal with this one, saying, "Hey, we'll carry your loan rather than you coming in with a different loan." If it works out for both parties, and then they'll be able to close quicker, because essentially you want to think of it as a cash transaction,
Right.
with a seller credit covering whatever that loan amount is. So those can be done, faster.
Quickly. Like a week.
Could be.
Okay.
When folks ask how fast can we close a transaction, it's really dependent on what needs to be cleared through the escrow process. So once the contract comes over, we'll search title, we'll pull up whatever encumbers the property,
Right.
find out if there's assessments, HOA, and a payoff, and those are the things that we'll have to work through to make sure that we get everything complete
Okay.
and cleared and then closed. So I always say, as long as there is a payoff lender that's willing to work quick, then everybody can sign. We had a closing that opened up contract Monday morning, and we were closed by Tuesday afternoon.
Oh, nice.
So it can be done fast. But I usually say about a week is a good amount of time to.
And there's no appraisal.
There's no appraisal. There's no inspection. Typically, I mean, they may want to do a home inspection, but there's no appraiser or anybody that goes out there that has to be done.
We can do an appraisal, that can be done, and a home inspection can be done, just to give you a baseline, maybe for where it might land, or making sure that you're spending the right amount of appraisals are done for the bank to assure that the property is in the right amount of money that they're loaning, and they're not loaning you $500,000 when the house is worth $100,000. So as the person purchasing the home, you may want an appraisal to make sure that you're getting the right price for the home, or that it's realistic.
Yeah, or hire a really good agent.
Yeah, a good agent does help too.
Helps it.
So sometimes with an agent, things they should be looking for if they're having a buyer that wants to do owner financing would be that it's free and clear of any note, like
It's helpful.
or that they have a low payment payoff that the buyer might be able to pay that off. Are there ways to do it if they don't? Is there a wrap or some kind of process they could do?
Just call those creative financing. It just depends on which direction they would like to go. And from a title perspective, is the title company willing to cover the risk that comes along with that? You mentioned a contract for deed earlier, which is essentially I'm going to pay you, and once I reach the point of paying you what that contract is worth, then the deed is going to be put in my name.
But the seller keeps the deed in their
That's
name.
correct. And they
Yeah.
keep the note in the loan if there's currently a loan.
And if you paid $100,000 on a $150,000 house and then something happens and you're not able to pay it, the seller can still take the house back in a contract for deed. Where in a deed.Trust, the buyer would at least get the equity they've put into the home if they had to sell it for financing. You didn't see that during the short sale period because everybody was selling it for less than they owed on the house. But if you owed not very much, if you had $100,000 in a $500,000 house and then you would sell it for $500,000, you could just give the $100,000 to the bank and then you would get the $400,000 like in a normal sale.
Yeah, so it can be tricky, but it can be very beneficial as well. But there's the wraps, there's a contract for deed, there's the assumable loans, but that it wouldn't really fit into this situation.
What's a describe our wrap?
It's hard for me to describe it out because I haven't really participated too much in that. But essentially, what it is you are deeding into the new owner. The new owner is making payments on the existing loan without that loan getting paid off with a standard transactional payoff. You're just paying towards that, the monthly payments. And a lot of times what will happen is that payment from the buyer will go to a long-term escrow department, and then that long-term escrow department will then make the payment to the lender. So I don't want to say that it hides the fact that the borrower on that note isn't making the payments to the loan, but the new buyer is making those payments. So those due on sale clauses could come up during a wrap process.
Okay.
If everybody gets caught with what's going on, you just have to be careful and mindful of that as well.
So it's important to work with somebody that knows what they're doing, asks questions. It's okay, like Alec has mentioned a couple of times, I'm not quite sure about that. I have that happen all the time. There are lots of people, we have resources that we're able to go find the answers out. And that's kind of how real estate works. You don't know all the answers.
Surround yourself with people that are smarter than you and it works out great.
Yes.
Yeah.
That's a lot of those people.
She's called me out twice for not knowing things, so
I haven't
make it through
today,
I'm sure.
I don't know. I've learned a lot today.
We're good. We're good.
From you. So there were lots of things I didn't know, which is why you're talking about it.
There you go. One other thing that I was going to mention for a buyer is the closing costs. So when you consider a seller financing versus taking out a loan with a bank or a credit union or mortgage broker, whoever it is,
right?
You're not going to have the same kind of closing costs at that point because you're not going to have the loan fees that go along with those. It's essentially you're just going to be paying the title and escrow fees. Usually the seller, as the lender, doesn't have costs that they pass along to that buyer.
Okay.
So there are some savings there, and just depending on what those fees could be, it could make a little bit of a difference in the down payment that the buyer has to bring in.
Okay. I think we've covered most of the pluses and minuses of doing it.
I think we're just going to start rambling here if we
don't just cut it off.
Yeah.
All right. Well, thank you for watching our
Glad you made it to the end.
First one. If you made it all the way to the end, we might give you a lollipop or something, but we will have more of these and we're excited to give it a shot. If you want to be on the podcast or you have questions or curiosities, we're happy to explore them.
Yeah.
Real estate curiosities. We will keep it really to what we know.
A little more industry related.
Industry curiosities, yes.
So sometimes after the pilot episode, characters are replaced by other actors. So if this is the last time that I see you on this one, enjoy the next person. Now, all this stuff is yours. You can't be leaving yourself out of it.
I have been to places where I was. Other people were like, "Thank you for setting all of this up. We're gonna just
got this handled.
We got this piece out."
Good.
Yeah, looks like the Ross original marriage in Friends.
Oh yeah.
Yeah, where his wife just
replaced
him with a girl. Yeah, same thing.
Yeah, we get into Friends too if you want to.
Yeah, I love Friends.
They only bought one piece of property in that, and Joey could not find escrow on the map. Remember that?
Oh.
They said it was in escrow, and he still couldn't find it.
Couldn't figure out why that wasn't me.
That poor guy. He really wasn't that good. Anyway, let's cue the out music. Are we done?
Yeah, we're done.
Okay.
Thank you. Let's hope it kept recording after I heard the email come in. We did a